Hello, everyone. Welcome once again. Let's talk about an important topic. Why do you need to keep multiple bank accounts? Maybe one, maybe two. If you look at your typical bank account, those days you'd have a bank account at the high street. And what would happen then is you go in and actually spend some time talking to your manager, have a chat, talk through your mortgage, talk through your credit cards. Financial planner used to be in the same bank. Everything used to be done face to face. But now things have changed. So, with the level of accounts that gets frozen, bank accounts closing down, banks just going down under or being taken over. So, it's not important to look through it and go, how many bank accounts should you have? Which is key. And a lot of people have asked me that. Again, who am I? So, you can see me with this loud, funny mic. Sorry, voice is a bit funny today. I'm on my way, so I'm traveling. But I think what's important is spend time as much as possible with my customers, talk to them and address questions that we have. So in this case, I think the question was, hey, how do I maximize and make sure that I'm protected in case my bank goes down? And it's possible that my bank will go down. And so again, I'm the head of Uruka. So Uruka is a fitness payment ring. In case you can't see it, this is a signet ring. This is a payment and a fitness ring at the same time. So it combines two actions in one, which is cool. We're the first to do this in the world, and we're excited about the prospects of what we do here. And we try and talk to our customers as much as possible. So in this case, the question is, should you have multiple accounts? Here's the short answer: yes. That's it. You can stop this video right there. If you say, if you admit that it's yes, you don't need any other or convincing, you're good. Just drop and go. Go open multiple accounts and have them. If you need convincing on why, I think it's important to see, again, look through history. If you don't go through history, it's hard to understand and learn. Sorry, guys, you might see some planes going past behind me again because I'm at the airport. I just have a few minutes, and I thought, I can watch Netflix, or I can spend time with my customers. I chose the latter. But anyone in the UK would realize there was Northern Trust. So Northern Trust, Northern Bank in the UK, they call themselves Northern Rock, sorry. They're up in Newcastle. And they're very good, they're very strong, they've been around for years. And then randomly what happened was you went in to withdraw cash in your account and you'd see that there's nothing there. It was all gone. The bank was gone, liquidity was gone, people were queuing up for days, months to receive that money. If you have any history like that that's not covered by the press, let me know. I'll put it in the comments as well. But it's common, more common than you think. And before then, it just doesn't happen. Okay, you don't expect it. You expect to always go into your bank account. You always see money in it. So when it does happen like that, it's a shocker. It also happened as well, just again, forget about Northern Trust. Northern Trust, we know what happened there as well. Again, for people who don't know, it's more or less about diversifying their deposits. So they had a lot of money on wholesale. And then when the public run happened, when people caught wind that maybe they don't have that cash, and they were gone. Silicon Valley was similar to that as well, but theirs was a lot more silly in terms of mismanagement, and where they invested in long dated ETFs and money market funds and treasuries. And then what happened then is when people had a run on the money, not that they didn't have the money. So imagine if you have 100 million in deposits, and then people come and want to withdraw 100 million straight away. People joke about this, but banks do have the money. They usually are capitalized. The question is they don't leave cash in there. So what happens in this case was they had to go in and go to the ETFs, the money market funds, or the treasury funds, basically anything that I'm trying to simplify this as much as possible. Anything that the banks would usually invest in, it takes a few days, months sometimes to actually redeem those funds, especially if it's long dated. Long dated, that means it's over 3 months. Again, if you invest as a bank and you lock it on for a bit longer, what happens then? You get more interest, a favorable interest, and that's where banks make their money. Yeah. So when people say, "Oh my God, my bank is free," it's not really free. The fact that you're depositing money with them, they use that money to invest in what's called a long dated security as long as possible, and they get money off it. But they give it away to mortgage, which is long dated by its name, long date. And then they go ahead over sometimes 30 years, and then they amortize the money or bring it back into present value, and that's where they make their money. So that's what happened again with Silicon Valley Bank, and before you knew it, a lot of millions of people who needed funds could not go in, and that bank was gone. And there's a lot around the world. We all know in Europe, but coming back to Europe as well, there was Greece. So Greece had the national debt where most of their banks was gone, closed. In fact, they actually started limiting people to 60 euros. That's the local money in Europe. 60 euros per day per customer, just to increase liquidity and make sure customers have fund and there's enough cash to go around while they try and withdraw or call back debts that they have. Again, there's a lot of these banks which you can bring up, and when that happens, people get nervous and get worried. But you always have to think before then, right? What would have happened before then? What should have happened before then? Yeah, and that's the topic of this video. Okay, and a lot of things could happen. Like what caused Silicon Valley Bank, for instance, which I've just said it as well. So there's a lot of things that can happen that leads up to this, right? It could just be that the app is down. You know, it could just be that oh my goodness, the regulators want to look into your app, which happens a lot with us. It happens with a lot of apps. Anyone could come in and say, hey, we want to look into your app. And if that happens, sometimes the app could be down because that's being looked at. I know, for instance, Wirecard. So Wirecard were a UK, let's call them fintech. A bit like MasterCard, okay, they were behind. So you wouldn't usually see Wirecard. But what they did was behind it, they did all the transactions and money market movements. So very, very huge. I think they originated in, correct me if I'm wrong here, guys, somewhere in East Europe. The guy was a whiz kid. I think he was like a Russian and really good in math. So he came in with the right spirit to actually build that company. And the idea behind Wirecard as well, same thing. There was a lot of fraudulent activities happening in the back end there. And that would not have gone out or wouldn't be an issue, except that the banks who relied on them, fintech apps who relied on them, had issues. So I know specifically Curve, if anyone knows Curve are a fintech app like, I don't know, like Mercury in the US, Yota, OPay, wherever in the world, right? You always have those fintech apps which are in front. I'll talk about fintechs in a minute. So specifically what happened then is those guys wanted to then use Wirecard and withdraw money. But since Wirecard was down because of investigation, all the front-end apps that relied on them were down. And what happens then? You go into a shop, you want to withdraw your cash, you can't work, or you're on a train station, you're stranded for the day, wherever you are. Unless you can somehow get someone who could borrow your money cash, not through the app. This is what I mean. So that becomes an issue. But again, we know that as well. That's a long time ago. Wirecard, I think, is 2010, if not more, at this stage. So how about the latest one? I think the latest one that we know of, because we're trying to work with people that they work with. In fact, we approached them, and it's Yota or Yoda, as you guys call it in the US. So Yoda is one where again was a fintech app upfront, but and nothing was wrong with Yota. So Yota were meant to be a savings app, but they tried to gamify the savings, so that if you invest money, then you have a spinning wheel, and then it encourages people to save because now they're gambling and saving. To me, it didn't make sense, but we're like, okay, if you're doing that, that's good. However, the people they worked, which is okay, they raised a lot of money. And that's the downside. People just look at people who raise money and believe that raising money is what brings success, but not. Because what happened then is they went in and they raised a lot of money and they worked with a bank called or a back end called Synapse. Synapse then became the actual people who did the KYC, know your customer. They did the onboarding. When you onboard, you think you're talking to Yota. Yota is just a front end that allows you log on, see your balances, see your money. But they were not regulated, right? And they were not even a banking as a service provider. The banking as a service was done through Synapse. Synapse themselves, again, their criteria, I can tell you, we went to Synapse as a brand new app. Thank goodness they didn't accept us. And the first question they asked us was, how much have we raised? Which I think raised alarm bells. Luckily, we hadn't raised money. We'd come in again, it was us, a few bankers have come together to create this app for our customers. So we thought it was a cool app. And we said, hey, we're going to cool app here. Can you work with us? And we're like, nope, you need to raise 10 million before we talk to you. Now it makes sense why they look for people who raise money, because what happens then, that money then is what they use, and God knows what they were doing with it. Then they went down just a couple of years ago. And what happens then is because they couldn't find where money was and they were embezzling money that came through from Yota, Yota being the front end app went down. Okay, so a lot of customers lost money there. So if people had savings there, because again, there is savings app. It's very different from us because we're a payment app. That means most of the money that comes in, our customers use them real time. And that's very good because again, you can trust. You use our rings, you make your payment, you go. I prefer that in terms of transaction. It also leads people to use the app a bit more than savings app or investment apps where people try and force people to use it, right? And come up with gamification to try and get people to use it. For us, we don't, because people use it. If you love your rings, or for some reason you don't want to expose yourself or expose your bank account or expose your phones, okay, because of how dangerous it is out there, use your ring, and people are using it naturally. Yeah, but a lot of these apps don't, and that was a problem Yota had as well. They tried to get people to go in and use the whole gamification aspect of things to get people to use the app a lot more, which I think brought down the functionality there and made them desperate to go ahead and work with Synapse, which brought them down. Again, my point, I think, if you haven't seen it by now, is the fact that anyone along the chain can break, which would cause your banking app to be down. Think about that. So those days, it was the same thing, right? So we know for Silicon Valley Bank, you have a bank. A lot of people say just go to a bank because it's physical. No, if you go to a bank because it's physical, the bank themselves have to take your money and they have to invest it. If they invest your money incorrectly, you're still in trouble. It's still the same thing. You're not protected because you went to a bank that you can see there's brick and mortar. In fact, those banks that are brick and mortar, what do you call them? Brick and mortar means that they're physical. You can see them, they're buildings. But those guys that are buildings, they pay for those buildings. That means they're more incentivized to invest your money. Okay. So those guys, again, that's true. There's not a lot of middlemen. That's a positivity there. But the negative part, and more important part, is the fact that it takes a lot of overhead to maintain those tall, huge buildings. JP Morgan buildings are the biggest in the world. Why is that? Goldman Sachs, same thing, right? Citibank, Bank of America, all these traditional buildings, wherever country you are, right? If you look at it, those buildings have to be maintained. Yeah, and they force people to go into the office, by the way, because of this, because they have to use them, they have to maintain it, and they have deals with local authorities. Yeah. So the point then is the fact that those guys, because they have to do it, they have to go out and invest the money. And investing carries risk. That's why you see banks going down. That's why you saw Silicon Valley going down. Silicon Valley were nice. They tried their best. They're a physical bank. A physical bank doesn't mean you can go get your cash. And that's where fintechs like us came up. In fintech, the idea is the fact that fintech doesn't need extravagant buildings. You don't need all the head count. You just go pure tech, right? That means you strip away all the unnecessary tellers, customer service front end that stands there and just greets you. You know, security that just opens the door. You don't need all that. So if you strip that out, all you have is just an app where you can log on. You don't have to go in and book an appointment. Okay, you go in, you log on, receive your money or make your payment, and you leave the bank or leave the app. Right, that's you. That's done. And so that's where fintechs came in. But the downside with fintech is the fact that there are a lot of middlemen. Okay, so if you look, I just talked about Yota, right? Yoda. So Yoda was the front end. They have the banking as a service provider who will then do the KYC. They do the anti-money laundering checks. You can do both at the same time. But generally, they outsource that because it's independent and you can keep track and focus on your core business. So your core business as a fintech should be customers. Okay, if you're looking at customers, that means you need to outsource compliance and all of that to a different entity. That's two. But three then becomes a connection to the bank, which we now call banking as a service provider. If you're not doing that yourself, you're outsourcing that. That's three. Or when they're going to four, which is the bank itself. Fintechs generally are not, unless you go in and get a banking license, which you see a lot of fintechs today doing. I don't support that. I don't agree unless it's really, really needed or really, really required. And so if you're a fintech, you need to focus on the customers, improve customer experience rather than going to get a banking license. So what usually happens, at least traditionally, is that you have three people. You have your fintech, you have again the KYC, AML app that does that. Then you now have your banking as a service provider. And then lastly, then you have the traditional bank. But in this case, the bank then would accept you as a fintech, which is a lot cheaper for the customer then. And those are the two types of relationships you can have when it comes to your money. But I think the idea then becomes, what do, to protect yourself? Because again, physical banks are expensive. They invest a lot and they cost money. A fintech, on the other hand, you might have the issue with risk. You can have the issue with tracking money, or even just the app going down. Okay, so there's a tech risk there. I think the reason then, what you can do is, well, number one is just make sure you're protected. A lot of regulators these days insist on you having your having the fintechs themselves or the banks have some financial insurance guarantee in place for customers' money. So a lot of people do that today, which is good. So make sure you optimize and use that as much as possible. Yeah, I use the phrase optimize because people are just happy to use it. Okay, what that means then is, if you have a bank, okay, and then for some reason the bank then not allows you, but the bank would say, hey, your deposits are insured. Okay, now if you're lucky enough to have over 250K, which includes mortgage, anything with the bank, 250K, guess what? That's gone. So anything over 250K, they can't insure you anymore. So if that bank goes down, that money's down. So what you want to do is make sure, then that's where optimization comes in. Where you're going, and there's nothing crazy about this. You don't need someone special to tell you this. The rule is simple. As long as you stay within the same group, you're insured up to X amount by the insurance. It could be 100K, it could be 250K, depending. You have to look into your country on this. The US accepts 250. Within Europe, it's 100K. Asia, different amounts as well, and Africa as well. So what you want to do is make sure that you look, and again, you don't need anyone to tell you this. No guru should come in and teach you and then charge you here. Go in and search, is my deposit guaranteed? Yes. The app will tell you specifically how much is guaranteed up to. Simple as that. And if you use your app, okay, up to the 250K, then make sure you go to another bank. That's it. That's the message here. Use other banks for this. Because that bank, no matter how much you love the CEO, no matter how much you love the app, if they go down, which will, yeah, no bank has been around forever. Even JP Morgan has lasted just a few hundred years. At this point, it might go down next year, 2 years when Jamie Dimon leaves, right? Jamie Dimon. So the idea now, I repeat, is one, make sure you utilize your compensation up to the max. And if it reaches the max, use another bank and make sure that other bank is not within the same group. Because there's no point going from Amex USA to Amex Group. It's still the same, all right? The insurance is at the group level. So you just make sure you go in, you order your bank, and go to another bank once that limit is reached of 250K or 100K, depending on the country you're in. Okay. And then lastly, then becomes, when you've done that, what next? Okay. So, and that's where I talk about diversification. So what that means then is if you've got money coming in and your money comes into one bank and you use just that one bank, it is possible that that bank will let you down at any point. Yeah. Unless they know you, physically, unless they actually, not even, unless the bank manager knows you and everybody in the bank knows you. Okay. Which is tough these days. And we don't have the time for that. I mean, in the 60s, 50s, even up to the 80s, you could have done that, walk into a bank and everyone knows you. And even then, there was still about 0.5% chance that your account could be blocked for something suspicious where they're not really sure. Now it's a lot higher. Yeah, because of KYC, which is, know your customer versus anti-money laundering rules. Against even anything suspicious at all, the banks have to investigate, and that takes months. So to avoid that, what do? You make sure you have multiple banks. Yeah. And I always say this is what you need to have 4 banks, minimum 4. Okay. You have your current account where the money comes into. You have a backup. I call it pay yourself account, which is basically these rings. These are pay yourself accounts. Your fintech app can be a pay yourself account, because what I mean, that account is where your money that you want to spend yourself goes into, not your main account. And with that, you can travel if you wanted to. You can buy yourself something nice if you wanted to. Oh wait, if you've got a partner, it goes into 2 accounts. Those 2 accounts, then it's actually what you use. That's the 3. And then number 2, then you make sure you have your savings account. You must have a savings account. And I'm going to set up a whole video on this one because people are geniuses at telling you how to invest your money. Go into this high yield of investment of this amount and this amount, and then you fight over, pennies. Okay, you fight over pennies, and then you say, oh, it's going to grow up. Oh my God, it's going to yield in 30 years. It's going to be this amount. People worry about the 30-year goal. That was starting from now. Do you have a savings habit? If you don't, then focus on that first. Get a savings habit. When you have a good savings habit and you've gotten up to a significant amount of investment in terms of 20K, $50K dollars worth, and then you can start looking into how to put it into a yield. But before that, before you get into a savings habit, there's no need fighting or worrying about which bank gives the more, and you start moving around 1K or 2K. It's not worth it. Okay, focus on yourself, focus on your savings. And once you have your savings in place, obviously get your retirement. Depending on what age you are and your risk appetite, is important to look at your retirement account. But again, I repeat, I think what's important for us to note is that you need to have, number one, primary account, which is where your money comes in, your backup account or pay yourself account for expenses for you and your partner, the savings account, and your retirement account. Done. If you have those 4, at any point, if one of them goes down, in fact, you'll be hard pressed to have 250 across that. Okay, if you have 250 across all that different groups, get more. Okay, get another backup of a backup. Okay, and keep going like that. Okay, as many as possible, because again, there is no loyalty in this game. Banks are not loyal to you. They're loyal to their investors. The investors is where the money comes in. The investors pay their bill. If you doubt me, right, pick up your phone and call your CEO of your fintech app. Let an investor also call the CEO of a bank. Trust me, the CEO is going to hang up your phone straight away and pick up the investor's call. The investor's call is more important to him. That's it. That's the truth. So banks fear, I would say worship investors a lot, right? And that's the truth because they pay the bills. If things go wrong, they ask for money, 100 million tomorrow, the investor gives them. So what that means then is you need to then think about yourself and not stop thinking about your bank. Okay, get multiple banks, make sure you're protected. Make sure if something goes wrong in one bank, while they do their silly investigations, you move on and you do something else with your cash in another bank. Okay. And then one last point, I think if you have, if I haven't said it again, is if you're a business, if you, and I'll say this again, if you have a small business, have a separate account as well. Because what you don't want to do is make sure is have your personal account blocked. If your personal account is blocked, guess what? Your business account will most likely be blocked. So if you're a small business out there, make sure you have a business account that's separate from your current account. Your bank will do anything to have those business, okay? And that's true. Relationship manager, they get bonuses for signing you on, not because they love you. So in truth, if you have a personal account and you have a business account, make sure it's separate, two separate accounts. In case one goes down, the business can still start. And there was I think, yeah, the Silicon Valley Bank that had millions. I mean, go to one stage. I think a lot of small businesses had their personal account and their employee account in there. So what happened then is when Silicon Valley went down, they had no one. Like you'd have a CEO that's come in there that has to pay. He hasn't paid himself. He had no money to it because his account is blocked. But he had to go look for money to borrow to pay his employees because the employees were also in Silicon Valley Bank. Don't do that. And don't wait for it to get to that level. Right now, if you, after this video, if you're still doing this, go in, open a business account. And there are a lot of banks these days that open business account. We're not recommending. Okay, we have our own recommendation on our rings and our pay yourself accounts, right? Payment account, expense accounts. But to us, I think if you want to get a business account, make sure you get a bank that would give you a business account and you have that relationship with them only. Such that if something goes wrong with that bank, you know it's isolated to that bank, okay, and no one else. So make sure you do that. But within that as well, make sure within the again, going into companies a little bit here. If you have a small business account, make sure you have the company expense. Oh, you always know this, right? The company expense has to be different from the customer's cash, okay? It should also be different from your employees' cash because you have to pay your employees, okay? Which is separate from your company expenses. So to me, make sure you have minimum 3 different accounts for your small business, okay? So that becomes big. Now you have 7 accounts. Well, you know what that means? That's diversification. Because if for some reason any of those, but you'll be hard pressed to see 7 banks go down. At least 1 or 2 of those, 3 of those will be good. Okay, so I hope I've answered that long-winded question. I need to go check my flight now and see we're boarded. But as it stands, please have multiple accounts and please diversify and make sure you have multiple accounts and make sure they are not within the same group and make sure you all have some sort of insurance in terms of the deposits. And for us, make sure again, obviously, you order our rings, you spend again without needing your wallet or your phones because you just tap and go. So if something does go wrong with your personal account or your corporate account, you can always use your ring and just keep going to where you're going. Because at the end of the day, in truth, every day, the average person doesn't spend a lot. Okay, you're not spending a lot. You don't need your phone, your wallet, or your computers these days just to buy coffee or to buy food or to buy snacks daily, or to buy lunch or work. Nowadays, everything is just quick. So the quicker it is, the better. So that's why we have our rings, which you just tap and go. If you want to watch your fitness as well, you have this for fitness. So these two combined just gives you everything you need. This is a signet ring, by the way. So I should have said that at the start. This is a signet ring. And what that does then, that actually gives you like a family tree. So this is digitalized. So when I tap this on the phone, if I tap this on the phone, it actually gives you my family tree, which I think is very cool. Check it out online as well, by the way. So www.oruka.com. So thank you very much. Thanks for joining the call. Thanks for being a part of the community. And see you in the next one. Bye.